This presentation is for Chapter 7, Internal Control and Cash. Exercises QC 1 through 6, S7-2, S7-4, S7-5, S7-8, and S7-11. You should pause the presentation and complete these exercises, then come back and review the presentation to check your answers. The first question is, which of the following is not a part of the definition of internal control? The answer is separation of duties. While separation of duties is necessary to accomplish some internal control goals, the other three are parts of the actual definition of internal control. This question concerns the Sarbanes-Oxley Act. The correct answer is requires that an outside auditor must evaluate a public company's internal controls. The other answers are not correct. The first answer is wrong because it is the Public Company Accounting Oversight Board, not private company. The second one is not correct because the Act prohibits many types of consulting work for public companies. And the third one is incorrect because violators of securities fraud serve 25 years in prison and not 20. Encryption rearranges messages by a special process is the correct answer for this question. Encryption is a vital component of internal controls in e-commerce because it provides security for information that is sent electronically from being intercepted and used unlawfully. Separation of duties is important for internal control of both cash receipts and cash payments. Separation of the duties of custody of cash and recording of cash is necessary to prevent theft. Michelle Darby receives cash from customers. Her other assigned job is to post the collections to customer accounts receivable. This company has weak separation of duties. Michelle has both custody of cash and the ability to make entries in the accounting records. This weakness could allow her to steal customer cash receipts and conceal the theft through entries made incorrectly in the accounting records, such as writing off a customer's charges for the same amount that she stole. Sandra Kristoff sells furniture for McKinney Furniture Company. Kristoff is having financial problems and takes $650 that she received from a customer. She rang up the sale through the cash register. What will alert Megan McKinney, the controller, that something is wrong? When the controller matches the cash register tape to the day's deposits, the deposit to the bank will be short the $650, and Megan will have to find out what happened to the money. She can track the amount back to the cell and the person who rang it up, and then she will ask Sandra about it. Payment by check is an important internal control over cash payments because the check must be signed by an authorized officer, and before signing the check, the official reviews the invoice supporting the payment. Both of these controls help to ensure that only authorized payments that are actually due and valid are paid. A purchasing agent for Franklin Office Supplies receives the goods that he purchases and also approves payment for the goods. The first question asks, how could this purchasing agent cheat his company? The purchasing agent could buy goods and have them sent to his or her home, or a purchasing agent could spend too much on purchases, approve the payment, and split the excess with the supplier. How could Franklin avoid this internal control weakness? The purchasing agent who prepares the purchase order should neither receive the goods nor approve the payment. This exercise asks us to prepare the journal entries for the petty cash transactions for Everly Gaming Supplies. The first entry on March 1st is to establish the petty cash fund with a $250 balance. The entry would require a debit to petty cash for $250 and a credit to cash for the same amount. The next entry on March 31st is to record the following petty cash fund transactions. The fund is counted and there is $24 in cash still left. There are $235 in petty cash tickets that were issued to pay for office supplies $35 and entertainment expenses $200. We will now make the entry necessary to replenish the fund and record the expenditures. To make this entry, we will debit office supplies expense for $35 and entertainment expenses for $200 and credit cash short and over for $9 and cash for $226. The fund should have only had $15 in it based on the receipts that were found, but it had $9 more, so that amount was credited to the cash short and over account. The $226 check will be cashed to replenish the fund back to the original $250. The last entry on April 15th is to increase the balance in the petty cash fund to $300. To make this entry, we will debit petty cash fund for $50 and credit cash for $50. The $50 check will be cashed and the cash will be added to the fund balance. In this exercise, we will identify timing differences related to the bank reconciliation. For each timing difference listed, we will identify whether the difference would be reported on the book side of the reconciliation or the bank side of the reconciliation, and then whether it would be an addition or subtraction. The first item is deposit in transit. This would be a bank addition because these are deposits that have not yet been recorded by the bank. The next is a bank collection. This would be a book addition because these are amounts that the bank has collected that the company has not yet recorded. The next is a debit memorandum. This is where the bank subtracts an amount from the account, so this would be a book subtraction. The next is an EFT cash receipt. This would be a book addition because it is a receipt that the company has not yet recorded. The next are outstanding checks. These would be a bank subtraction because these are checks the company has written that have not yet cleared the bank. The next is a $1,000 deposit erroneously recorded by the bank as $100. This would be a bank error and it would be an addition to the bank balance for the difference of $900. The next is the service charges. These would be a book subtraction. The next is interest revenue. This would be a book addition. The next is a $2,500 cash payment for rent expense erroneously recorded by the business as $250. This would be an error in the company's books and would require subtraction on the books for the difference of $2,250. The last is a credit memorandum. A credit memorandum is where the bank is increasing the company's bank balance, so this would be a book addition. In this exercise, we will compute the cash ratio for Smith Banners. Smith Banners reported cash of $26,500 and cash equivalents of $5,000. Their total current liabilities were $30,000. To compute the cash ratio, we would add the cash and cash equivalents together for the numerator of $31,500 and divide this by the total current liabilities of $30,000 to get a ratio of 1.05. This tells us that for every $1 of current liabilities, we have $1.05 of cash and cash equivalents. This is a good cash ratio. And that is the conclusion of the demonstration for Chapter 7 exercises.